I'm going to show you my foolproven system that has gotten me over 217 payouts, and all of this with just 3 simple steps so that by the end you can start applying this yourself. And it's so simple that even beginners couldn't mess it up. And in this video, not only am I going to be explaining the strategy, but I'm also going to be backtesting it right in front of you so you can see it playing out. What a lot of traders fail to understand is that in order for a strategy to be scalable, it needs to be repeatable, because this is what creates confusion and a lot of blown accounts. And believe me, I've been there. I didn't make any sort of money from trading for over 2 years until I finally had my breakthrough. And this is why I developed this strategy that has made me receive over 217 payouts. And here's the problem, or a very big warning for you. If you only have one step, this strategy is not going to work. So let's run through all 3 of them. Starting off with direction. Direction is required for everything in your trading. If you don't know where the market is heading next, it doesn't matter what the entry model or strategy you use, because you will always end up on the wrong side of the market. Right now, it is obvious that the market is moving bullish. So a lot of traders would say that the direction of the market is bullish, and they would be wrong. And the ability to call these reversals or simply not trade them is incredibly important. And I'm going to dive deeper into it further down the line, because there's a clear way to forecast these consistently. So we always need to ask ourselves one question. And that question is, what is the market choosing to respect? And the way we get to this answer is by identifying the key levels on the chart. And the key levels on the charts are going to be order blocks, fair value gaps, highs, and lows. For traders who don't know, order blocks are simply on a bullish trend. The bearish candles are going to be an order block. So right here, you can see that the market moves bullish, pulls all the way back towards the bearish candle, towards the bullish order block, and then we have that move higher. The fair value gap is a 3-bar pattern between the first candle high and the third candle low for the bullish fair value gaps, or the first candle low and the third candle high for the bearish fair value gaps. So now that we know all of the key levels that we have to identify, the only thing missing is identifying those key levels. And this we do on the daily chart. So let's quickly identify the most recent fair value gaps and order blocks that the market has. Right here we have a bullish fair value gap, another fair value gap, and the order block all the way down here, followed by this bullish fair value gap. Now, we can see that the market has already chosen to disrespect the first bullish fair value gap, and we didn't have a strong reaction out of the second bullish fair value gap, which is this one right here. And so right now our bias would be bearish, and we would only be looking for shorts. We have the move lower, we pull back to the order block, we have a strong move higher. So what is the market choosing to respect? It continues moving to the downside because we failed to respect all of the bullish key levels. And now, even though we are at a bullish key level, the market still is choosing to respect the bearish key levels. And all of these are being disregarded. And therefore, we would be bearish on the way down. And notice how right now we are not only at 1, but we chose to respect 2 bullish order blocks. And this is where we have that strong reaction. And so therefore, we would be now bullish towards the next bearish key level. And this is where we have that strong move higher. So all of this is how we can consistently predict the direction of the market. So the process that we are going to be following every single day is going to be 15 minutes before the session open. We're going to be looking at the daily chart and the 4-hour chart. And then we're going to ask ourselves, what is the market choosing to respect, and where do we go first and where do we go after? And this is going to give us our direction. Why? Because as you saw, we are able to consistently predict where the market is going to go first towards the bullish key levels and where it goes after towards the bearish key levels as the market moves in a cycle from bullish to bearish and bearish to bullish. And it's important to keep in mind that when we're following the direction, there are high probability and lower probability conditions. So for example, if the daily is bullish, yet the 4-hour is bearish, then this is going to be lower probability conditions. Yet, if the daily is bullish and the 4-hour is bullish, then we have high probability conditions. I could go way deeper into market direction, but I want to make sure that this video is concise so you have a strategy to run by the end. If you want a free deep dive course on direction, just go to mastertradingdirection.com, which is the second link in the description. But here's the problem. Now that we know the direction, we can still get caught and enter on the wrong part of the move. And you've probably been there before, where you finally know the direction and you just keep getting taken out before the move actually happens. And this is where step number 2 comes in, which is going to be market structure. Market structure is the basis of a high probability trade. It's also the basis of how price delivers. And that is what is important in pillar number 2. And we're going to follow the price delivery of a market maker model. So a market maker model simply shows that bullish price delivery, which is a market maker buy model, has a sell side of the curve, hits a key level, and then gives us the buy side of the curve. And what happens with a lot of traders is that they get stuck in these moves down because they see a lower time frame reversal right here, and then the market moves lower, lower time frame reversal, and then the market moves lower. And then we have bearish price delivery for a market maker sell model, which means we have a buy side of the curve first and a sell side of the curve once we hit the higher time frame key level. And once again, traders are caught shorting these lower time frame market structure shifts, and then the real move happens. So what we're going to focus on is going to be direction, market maker models, and identifying higher time frame key levels. So this is going to be step 1, this is going to be step 2, and entry model will be the step 3. And the key levels that we use in identifying market maker models is going to be the same as we use for identifying daily bias. So we have order blocks, fair value gaps, highs, and lows. So let's hop on the charts and show you some examples of what a market maker model actually looks like. So here we have a market maker buy model. The market is moving to the downside, it sweeps a massive low on the left, and then it starts moving bullish. And a lot of traders get caught in these short-term moves to the upside while the market is still moving lower. But once we hit that higher time frame key level, which I will show you how to identify, then your strike rate is going through the roof. Now, this is a blank chart, so let's just draw on all of the order blocks, fair value gaps, highs, and lows. Zooming in into the most recent price, we have the most recent order blocks. We have the large order block, we have this short-term order block, and we have the extreme order block. Now, drawing on the fair value gaps, we have the inverted fair value gap, we have the small fair value gap, and we have this fair value gap that the market has already reacted from. Then we have the internal low, internal high, and external high. So when we ask ourselves the question that we talked about during the daily bias part, we ask, what is the market choosing to respect? And I think that it's very clear that a bearish fair value gap was disrespected, and so therefore, notice how the bullish fair value gap gets respected, the bullish order block gets respected, the bullish inverted fair value gap gets respected. All of these bullish order blocks are being respected. So therefore, you would be incredibly bullish, and this would be a high probability price delivery. So we expect the market to go from these order blocks towards the external highs. And a little bit after, we have very strong price delivery. The same thing here. This is the 1-hour chart on NASDAQ. Let's quickly identify all the order blocks. So we have all of the order blocks right here, a very strong one, these small ones, this extreme, and this internal order block. We have the inverted fair value gap, and we have all of the highs and the lows. So what is the market choosing to respect? It's choosing to respect bullishness. Now that we understand the direction of the market structure that we're going to be looking for, there's only one problem left, which is understanding how to execute on this strategy. Because as we mentioned before, no strategy works if you don't have all of the pillars. So step number 3 is going to be the entry model. So we call this the North Star entry model, and the checklist is very, very simple. We define the direction of the market, bullish or bearish. We identify the higher time frame key level that we expect the market to manipulate to. And once the market reaches that key level, we will only be looking for a 5-minute engulfing candle. And we enter with the stops below the body of the engulfing candle. So here's a quick example before we go into a forecast. We have a very bullish daily bias as the market is constantly reacting out of the bullish order block. And we have a clear target that the market is targeting as liquidity. So now we just have to identify the key levels. We go on the lower time frame and we can see strong order block, fair value gap, order block, internal order block. So now that we have the key levels, we just wait for them to be tapped. And we can see the market comes towards the order block. It engulfs the previous move because what is required is a close above the 50% of the bearish candle. We enter with the market order with the stops below the engulfing move, and we target a 1 to 2 risk to reward. Now let me show you how to apply this on the charts. We identify the key levels first. We have a bullish key level, a bullish key level, a bullish gap. So the market is obviously respecting those bullish key levels, and we would target the bearish at the top, this extreme order block, and the final one at the top. So now we identify the key levels on the lower time frame before the session open. We can see that the market has moved towards the bullish key levels. I can delete them now just because I don't want too much clutter on my screen. We identify the key levels before the session, so we have an inverted fair value gap. We have an order block that we are reacting from. So what we're going to look for is just the market coming towards those key levels, engulfing, and then moving higher. Now we go on the 5-minute chart and we simply wait. So we're going to have the market open right now. What we want to see is the market coming back to those key levels before moving higher. Let me make sure that I also mark out the 15-minute key levels, such as these 15-minute order blocks. And now everything we have to wait for is on the 5-minute chart, the market coming towards the key levels and giving us that strong reaction that we can execute from. And after 5 minutes, we can see that the market has moved down and fully engulfed the move. So therefore, we execute with one contract, put the stop loss below the candle body, and we target a 1 to 2 risk to reward. And there we go, we have had our 1 to 2 risk to reward. I limit myself to just one winning trade per day, as I know that usually after a win or after a loss, this is where emotions come in. And the opportunity of taking these trades come multiple times per week, so we don't need to force any specific trade. So now let's go on to the next day. We are now on the 1-hour chart. We have hit the first higher time frame key level, the bearish one that we marked on the chart. But the market is still choosing to respect bullishness. And so therefore, now we're targeting the next one. So we go into the 1-hour chart. We can delete this one. We identify the bullish key levels. Right here, we have a 1-hour order block, 1-hour fair value gap, and we are currently at the 1-hour order block. So from here, I am looking for longs. I want to see the market engulfing after the market open, as we are on the higher time frame key levels. So we have that first strong move to the downside, and notice how we are still seeing strong manipulation bearish as the daily bias is bullish. This is because the market is manipulating traders out of the market, making them think that the market is bearish. Yet if you go to the daily chart and the 4-hour chart, you know that longs are still incredibly high probability. And now even more because we are at those strong higher time frame key levels. So you have that first move higher. We have engulfed 50% of the move down. So now we can enter and target a 1 to 2 risk to reward. So we enter in a buy. We put the stop loss below the candle body, and we target a 1 to 2 risk to reward. And the market shortly after, in just 10 minutes, provides us with 1 to 2 risk to reward. And so far, in just 2 days, we were able to take 2 trades. 2 of them were profitable for a total profit of $3,400. And obviously, we're still confident that we're going to hit the key level, which we do. Yet, we are going to continue looking for bullishness. Even though the market is close towards all-time high, we are not going to be trying to call the high of the market. We're going to ride the wave, because we can see after deleting this key level that the market is still choosing to respect bullish key levels. And this is where we once again identify all of them. We have the fair value gaps. We have currently no order blocks. So we want to see the market reacting bullish, engulfing on the 5 minute. And this is where we are going to take our trades. So we have the strong move lower. This is not market open just yet. Keep in mind. Okay, so this is market open. We have that move lower. What we're looking for is that bullish engulfing. So now we are at the higher time frame key levels. And we have a very strong 5 minute engulfing. So what we're going to do is we're going to execute with the stops below the candle body. And we're going to target a 1 to 2 risk to reward. And just 5 minutes after, we take a full loss. Now, maybe you expected me just to show you a perfect week. A week where we never take losses. But that is not the reality of trading. This strategy is going to have winners and it's going to have losers. But trading is about consistently executing on the same entry model for a long enough period of time. So let's go on to the next day. Now that we've hit the extreme and we started moving lower, I want you to ask yourself one thing. What is the market choosing to respect? And I want you to notice how the market has failed to create 3 higher highs. So that means that the market is right now choosing to respect bearish key levels. So therefore, we would turn our bias into a bearish bias now. So we now do the same thing as we did all other times. Identify the key levels and wait for the same entry model over and over again. So this is the session open. We have another bearish key level. So now what we want to see is the market moving to the bearish key levels and then moving bearish so we can execute on the shorts. So we have the market tapping the key level, moving bearish, which gives us a very strong bearish trade with the stop above the bearish engulfing move, targeting a 1 to 2 risk to reward. And we can see that within 10 minutes, the market has provided a 1 to 2 risk to reward, even though yesterday we had taken a loss. And this is the power of having a strong risk to reward and a strong checklist that you follow every single day. And on the last day, the market continues respecting bearish key levels. We identify the key levels we would want the market to react from. We wait for the market to move towards those key levels and then give us the engulfing candle, which we have right here, a bullish candle that gets engulfed. We enter with the stops above the body and we target a 1 to 2 risk to reward. And here you can see that even during a range bound market, the market still provides entries. And this has given us a total of 5 trades, out of which 80% were profitable and gave us a total P&L of $7,500 in this backtest. If you want to see how I trade the market every single day, I have created Funded Trading Blueprint, a mentorship focused on getting you profitable and funded in just 90 days. And if that is something that interests you, then sign up with the first link in the description. This is a premium tailored mentorship. If you want to master how the market moves, just go to mastertradingdirection.com or the second link in the description, which is my free platform with a full free course on trading direction. And if you want to check out the best prop firm, then check out Funded Next with this button right here, or the 7 rules that made me a profitable trader right here.